Okay. Good afternoon, everyone. Just let's hold for a minute for online students to join. Okay, let's continue. Today we are going to discuss about dimension of measurement scale. See, understand, anything which needs to be valued or anything which needs to be ascertained with the proper figures, we need dimension as to how it has to be calculated. Say for example, if you want to purchase something, you can only understand whether how much I need to pay or anything only if there is a unit attached to that, correct? Unit of measurement we call. In mathematics it is famous, correct or no? Unit of measurement, correct? Like centimeters, inches, feet, like that. When transaction takes place, what is the unit of measurement? It will be always in terms of money. So it can be, money means it can be expressed in terms of rupee, pound, euros, dollar, correct or no? But it has to be, the measurement will work only when it can be expressed in terms of money. That is one of the limitation also, correct or no? Wherever we can't measure it using money, we cannot understand the value of that, correct? Yes. Okay. So dimension of dimension of measurement scale, there are two dimensions to that. One is time, one is value. Okay, sir, what is time? Always remember, in terms of accounting, you record the transaction depending upon the time. Andre sir, I didn't get it. Say for example, if transaction has happened in the month of April, you will record it in the month of April. So if the transaction has happened in the month of Jan, it will record it in the month of Jan. So transaction is always recorded with respect to the period in which it has occurred. So we will focus on the period or the time period in which it has happened, and accounting will be recorded accordingly. Clear? Yes. Okay. Next is value dimension. Your assets and liabilities are valued differently based upon the chosen principle. Sir, what do you mean by this? Let's take example of building. Correct. Now, how do you record the building? Based upon the historical cost. Correct or no? So whatever we have, whatever expenditure has been incurred over that building, we'll record it at that cost, right? But every year we charge depreciation. Correct. So will that value change? Yes. Every year we use the asset, the value keeps changing. We keep depreciating the building, correct or no? Or sometimes what happens, say I constructed a building for 1 crore. Every year I kept on depreciating it. Say now 5 years has been done, 50 lakhs has been depreciated. Now the book value of the asset means the original cost minus depreciation will give you book value. Now that book value of the asset, say is 50 lakh rupees. But if you go to market value, the value in the market for that building might be 80 lakhs. Correct? Correct or no? Say the original cost was 1 crore, you depreciated. Now after depreciation, the book value of the asset is 50 lakhs. Now if you go to market with the building's market value is 80 lakhs. Correct? So book value is showing 50 lakhs, market value is showing 80 lakhs. So what we will do, we will decide to revalue the building. If you revalue the building, it will become 80 lakhs. So there are two ways, right? Depending upon what principle you adopt. If the principle I have adopted is only depreciation, then my building will be sitting at 50 lakhs. If I am adopting a principle of depreciation plus revaluation, then it will be what? 80 lakhs. Correct? So based upon the principle adopted, your assets and liabilities will change. Clear? Everybody? Yes? Okay. So accounting as a measurement discipline. So there are certain valuation principle in accounting. Valuation principle means what are the methods available in accounting for valuation. The first method is historical cost principle. We have already discussed the cost which we paid to acquire a particular asset or particular goods is called as historical cost. The next one is fair value principle. Fair value is nothing but the name itself says fair. That means what? Whatever the price is in the market as on date, we can say current market price is called as fair value. Say for example, when you purchase something and after 3 years if you want to go and sell it, what would be the value you get is nothing but fair value. That means the price it can fetch in the market is fair value. Clear? Say for example, let's take an example. I have taken a car, right? I purchased it at say 16 lakhs. Now I have used it for 2 years. Now if I go and try to sell that car, how much will I fetch? Clear? So what was the historical cost? Historical cost was 16 lakhs. What is the current market price? Say 8 lakhs. So that is your fair value. Historical cost is 16 lakhs. Fair value is 8 lakhs. Is everybody understanding? Yes? Okay. Next, realizable value. Ultimately, what is the value that can fetch if sold today? Now, let's go back to the same example of car. Car is purchased, say, at 16 lakhs. When, say, we have purchased in the year 2023. Okay. Now, 24, I used it. 23, I used it. Correct. Now, 2025, I used it. Now, in 2026, I want to sell. Correct. Everybody is understanding? Now, at what price I can try to sell? If I decide to sell, I can sell it at say 8 lakhs. If I decide to sell, I can sell it at 8 lakhs. If I only decide to sell, I will fetch 8 lakhs. So the moment I sell it, I get 8 lakh rupees. That is called as realizable value. Sir, I have not decided to sell it, but I just want to know how much is the current market price. The current market price is 8 lakh. That is your fair value. Clear? Sometimes, sir, so we can say that fair value is equal to realizable value if we sell? No. Sir, how, sir? What? Why it is not equal, sir? I will tell you what. Fair value is 8 lakh, but always remember when you try to sell something, there are other charges which you may end up paying. Say, for example, I may pay commission to the broker who has sold the car. Say, I pay a commission of 8,000 rupees. Now, how much did I ultimately realize? This will be realizable value. You're understanding? So fair value need not to be mandatorily realizable value, but in some cases, fair value is equal to realizable value. Suppose I am selling directly to the customer itself. There is no brokerage involved. Correct or no? That time fair value can be equal to realizable value. But if brokerage is involved, how much will I realize? Market price is 8 lakh, but will I realize 8 lakhs? No, I will realize only 7.92 lakhs. You are understanding the difference between fair value and realizable value? So this is fair value, this is realizable value, this is historical cost. Clear? The next one is present value principle. Simple rules, sir, I will tell you. 10 years back, if I had given 100 rupees, say in the year 2016, I gave you 100 rupees. How would be your reaction? Happy? 100 rupees was a good amount that time, 2016. In 100 rupees, at least you could have had one meal, one good meal, correct, in 2016. Now, 100 rupees. Forget about meals, sir. One plate idli vada is only costing 70 rupees. Correct or no? 70 to 80 rupees. Vada is higher than idlis now. 40 rupees one single vada. Correct or no? So, if I give 100 rupees now, will you be able to have the meal? You may have a breakfast or some snacks, but you can't have a meal. Not to the satisfaction. Say, for example, if you are very hungry and it is 130, 100 rupees I gave you, will you be able to eat that meal? Say, for example, let's take a classic example. In 2016, one meal in, say, for example, Kamath Hotel was 100 rupees. Correct? You ate, hogged happily, unlimited meals, that to 100 rupees. Today you walked into Kamath. Same Kamath Hotel, same place. One meal you ask. He said 180 rupees. What happened? Hotel is there only. Place is there only. Food is that only. What changed? Value of the money changed. That means what 100 rupees could have fetched you in 2016, the same 100 rupees cannot fetch the same thing today. That means, does 100 rupees change? 100 rupees remains 100 rupees only. So what changed? The value of that 100 rupees. What 100 rupees could have bought you in 2016, it can't bring now. You're understanding? Say in 2007-8, a salary in lakhs was like crores. Today, salary in crores also looks small. That time 8 lakh salary andre, in today's world it is 50-60 lakh salary package. Correct? Today 50-60 lakh package also we look at, this is nothing. We need more. Understanding? So what changed? The value changed. The value of the money comes down every year. It will never go opposite. Sir, can the value of the money go up? Rare, sir. Highly unlikely. The value always comes down. Clear? Everybody? Why, sir? Why it happens like that? The rule is simple, sir. Demand, supply, inflation. Correct? When inflation happens, price keeps increasing. The same 1 kg onion which you buy for 50 rupees today, those days it was 8 rupees, 6 rupees. Correct? So what happened? The prices moved up. Likewise, whatever we could have bought from 100 rupees, the value will keep decreasing. Clear? So present value of principal is nothing but your liabilities are valued at a present value of future cash flows. Liability or assets, anything. So what future cash flow andre sir nange artha agಲಿಲ್ಲ sir. Say for example, you have purchased an asset for 1 crore. Correct? Now using this asset for next 10 years you can earn the money. Okay, say for example, first year you can earn 20 lakhs. First year. Year 2 you can earn 20 lakhs. Year 3 you can earn 20 lakhs. Year 4 you can earn 20 lakhs. Year 5 you can earn 20 lakhs. Year 6 same, 7, 8, 9, 10, 20, 20, 20 lakhs. Now my question to you. The 20 lakh in year 1, is it same as the 20 lakh in year 2? Where did it go? So the 20 lakh in year 1, is it same as the 20 lakh in year 10? Will you be as happy as you get 20 lakh in the first year when you get 20 lakh in the 10th year? No. Why? As we told, the value of the money changes. So what present value says is, boss, do one thing. Do one thing. You, 20 lakh is earned after 10th year, no? But what is the today's value of that 20 lakh? Correct or no? You are unhappy because 20 lakh after 10 year. But can you identify how much is the value of that 20 lakhs which you will receive after 10th year? Correct? Can we arrive at that value? Yes, we can arrive at that value. How do we arrive at that value, sir? We take a discounting method and we use a percentage. We use a percentage. Sir, what is this percentage? This percentage will be arrived depending upon different factors. Bond yield rate. There is something called as bond yield rate. Discount. That bond yield rate will be taken as discount rate. No, don't worry. No, don't think too much about what is bond yield rate and all those things. That is not covered under your syllabus, and it is little bit a complicated concept for you to understand at this juncture. So let's just understand. The bond yield rate will be taken as discount rate. Clear? Will be taken as discount rate. Now that rate is used to convert this 20 lakhs into today's value. Clear? So we arrive from 20 lakhs, we discount every year, go back, and we arrive in year 0 or beginning of the first year. So this 20 lakh will become, say for example, 12 lakhs. Now the value of that 20 lakh which we will receive in the year 10, the present value of that 20 lakh is only 12 lakhs. So what can I say in simple terms? Today's 12 lakh is equal to 10th year's 20 lakhs. Understanding? Or the 20 lakh in the 10th year is equal to today's 12 lakh. Everybody is understanding? Yes, any doubts in this? No doubts? Pakka? Can we move it? So, present value concept, especially there is something called as Indian accounting standard, Ind AS anta kariti. So Ind AS majorly focuses on recording certain assets and liabilities based upon present value concept. So in present value concept, what we do is we will understand what is the future cash flow, and that future cash flow will be discounted and bought back to today's value. That value will be recorded in your balance sheet and P&L. Am I clear? Everybody is following? Now, don't worry what is discount yield rate, how do we do it? Those things are little bit higher. Okay. In one more small example, if I give, today, if you go and deposit 100 rupees, now you are having 100 rupees. When 0th year, let's say, you after 1 year, you get 110. Correct? So, can I say after 1 year, whatever 110 is there, that is almost equal to today's 100? That is why we keep the money in fixed deposits. Correct or no? Why? To adjust against the inflation. Bank is not giving you simply interest, sir. They are giving interest so that your money's value is decreasing. They know that. And that is why, of course, they will also use the money to give it to loan and earn more money than what they give. A bank will charge 12 rupees interest, but they will give you. So remaining 6% goes to bank. Clear, everybody? Yes? Okay. So this is the value. Now from 110, say for example, I have not given you this. I have only given you 110. Can you find out what was the value in 0th year? Yes. How, sir? This 110 will be discounted. Will be discounted. Clear? Everybody is following? Is any doubts in this? Pakka? Yes? Okay. If you want to find out how discounting works, this is a small example so that you understand. In 0th year, how much you had up? 100. First year end, how much you are having? 110. Let's take, how much is the increase? 10%? Yes. Let's take this as only discounting factor. Discounting factor. So let's take 110. Let's see, we don't have this information. 100 rupees anta namagu gottilla, sir. We have given 10%, we have given 110. Can we find out what is the present value? Yes. 110 divided by 1 plus I bracket n. Now what is I, sir? I is, n is clear. So 110 divided by 1 plus 10% raised to 1. 1 year still, 1 year we are coming back. How many years you are coming back? You have to see. From year 1 we are coming back to 0. End of the year 1 to end of the 0th year is 1 year. So that will be 110, 1.1. That will be. So did we arrive at this figure? Did we arrive at this figure? Understood how present value works? Yes, is that clear? So whatever is the future value, if you discount it and bring it to the present value, the value should be nothing but the current value of that future cash flow. Clear? It is the present value of that future cash flow. Future cash flow, how much you will get, sir? 110. Fine. What is the present value of that 110? 100 rupees. Am I clear? Copying, huh? In exam, if they ask a question like this, they will never give this figure. You have to arrive at this figure using this formula. So that is your present value. Clear? Next. So all these things we have already discussed. Measurement and valuation in accounting. Your measurement is done by only money, or numerical value should be associated with it. So numerical value. Then valuation is nothing but, just now we discussed, assets and liabilities will be valued depending upon the principle which you are going to use, or the methods: historical cost, fair market value, realizable value, present value. Clear? Everybody has understanding? Yes. Now coming to accounting estimates. Sir, what is this accounting estimates? Now you remember the word, I always use financial statement should be true and did I use accurate? Why sir we can't use accurate? The rule is simple sir. Why we can't use accurate is, now I'll give one example. Say you bought a machinery for 1 lakh. Now every year you are charging 10% depreciation. Now my question is, every year you are saying you are charging depreciation of 10%, no? Does that mean only 10% of your machinery is getting wear and tear? Who knows, sir? It may be more than that, it may be less than that. Sir, first year hosa machinery, so we'll ensure that we use it very correctly. Cleaning, lubricating, servicing, overhauling, everything on time. Now, this classic example goes with our boys. What? If we take a bike, first year, super shining everywhere. Ujju. Yeah, it should be always shining, correct or no? Second year, one small scratch gone. Done. Now anything will happen with that bike, correct or no? Yes. So second year, slowly that love decreases. Third year, fifth year, yeah. Correct or no? So this is how. Now my question is, second year also, there was a wear and tear higher than first year? No, you still maintained it. But are you not charging the depreciation similarly? So that means what? Is depreciation accurate figure or just a judgment figure? It is a judgment figure. It is not accurate figure. You are understanding? 10% is not accurate figure. Sometimes your machinery part might have only broken, but you would have applied a tape and still continued doing it. In bikes, the what indicators, tape, correct or no? Sellotape will apply till it comes completely out, correct or no? So we might have done that small adjustment, but does it mean that your bike is completely worn out? No. Does it mean your bike has never been worn out? No. You are estimating 10%, but that 10% might not be accurate, correct or no? So that is why, if you correctly remember, I always told you financial statements can never be accurate because there involves certain transactions or certain valuations where we cannot capture the actual data. That is where there comes a judgment. Judgment is nothing but estimate. We estimate the depreciation of the asset. We estimate the wear and tear of the asset of only 10%. But is that true? Don't know, sir. Correct? So what we are trying to do, we are only estimating it. We are not sure. So that is why whenever the word estimate comes, there can never be accuracy. Correct or no? There can be fairness. It can be fair, but it can never be accurate. Understanding? So that is why we say financial statements are true and fair and never use the word true and accurate. Clear? Yes. So like this, depreciation is one such example. There are many examples like this. Warranty. Yesterday we discussed warranty. Can you accurately say while selling, hey, this girl will never come for warranty claim? Hey, this boy will definitely come. We can't say that. It is just based upon our past trend and history. We will estimate this much might be our warranty cost. Correct or no? Nobody is sure that this will be warranty cost. No. One more example, gratuity. I said, this person will continue with me for next 5 years. She also told me the same thing, sir. I'll work with you for next 5 years, sir. I will achieve this, that, this. Third year, Dubai in the offer bantu. Right. With what achieve, sir? I have achieved more than you. I am going to Dubai. Correct or no? Yes or no? So what happens here also? We estimated her to be with us for 5 to 10 years. So we already made a provision of gratuity, but that person is not with us. So tell me, so that means first year, second year, third year balance sheet, was it accurate? No. Was it fair? Yes. Why? Because at that juncture, we thought she will continue with us for the next 5 years. Now she is moving out of the country. So now we rectified it. Today also, is it accurate? No, it is only fair. Like her, there might be many employees who may tell that we are going to work for 50 years here only till we hit 50, 60. But they will leave before 3 years only. Understanding? Yes? Okay. So there are many examples in accounting where we use estimation. Clear? So That is why we never say accounts can be or financial statements can be accurate. It can be only fair. Clear? Okay. So some of the examples are depreciation of assets, provision for bad debts, warranty liability, obsolescence of inventory, and fair value estimates. So what is this obsolescence of inventory? I'll tell you. Now, the typical in the current market, Gen Zs and what is the next generation? Alpha, Gen Alpha. Now, Gen Zs and Gen Alpha, they are so fast in terms of dressing, in terms of style, in terms of their swag and all those things. Today they are wearing cargo. Tomorrow suddenly cargo is out of style. Correct? They will suddenly come back to bell bottom. Right? Suddenly after 1 month, bell bottom is again out of fashion. Now they will come up with something new. Right? So what is happening here? The fashion industry is moving very fast. Because of whom? Because of the consumers. What was style today is no more a style tomorrow. What is a style in this month cannot be a style in the next month. It will keep changing. Right? So now tell me, say for example, let's take an example of what is your favorite store, Appa? Zudio? Cheap and best. 5 and Banana Club. Okay. Whatever it is. Zudio is very fast trending because what? Cheap clothes and exactly it matches the validity of the Gen Zs and Gen Alphas. It will come for 2 washes. Third wash, gone. Correct? And that is what Gen Zs also want or Gen Alphas also want because they are fast moving. Fashion industry is moving very fast. So they will buy it 299, 99, 59, 199, whatever it is, they will buy it, wear it for 2 times, gone. Now let's say you are a business manager of Zudio. You are a product manager. Now you said you bought one designer cargo and you said this is going to make wonders. And you manufactured say 10 lakh pieces. Yes. You gave it to the market loved it, they bought 5 lakh units, gone. Correct? By the time remaining 5 lakh units were about to sell, some other brand bought the similar cargo with a better design than yours and which is more fast forward. Now what will happen? Your inventory gone. 5 lakh only, another 2-3 lakhs might sell, but remaining 2 lakhs. So what happened? Your inventory became obsolete. Correct or no? It became waste. It becomes outdated. Correct? It is no more in terms of the market. Correct? So it became outdated. Right? So that is why that obsolescence of inventory is also estimated. The brand product manager who told that 10 lakh units you make, he knew while making only that 10%, that means what? 1 lakh pieces I am sure short, it will be held back. Now where does that 1 lakh go? Brand factory. Correct or no? Half of the price which you get even in the Zudio and Westside. Correct? Or it will go to the thrift shops. Correct? Or it will go to this, you must have seen in Vijayanagar water tank and all, that roadside they will put one stall in the Omni car. 100 rupees, 100 rupees, 100 rupees. Yes? There. Correct? But what happens? Sir, but ultimately we are selling. No, sir, there is no loss. No, no. When you sell at Zudio, you are selling at 199. But when it goes to him, 199 for one lot, he will buy you at. Understanding? So he will lift in a lot. You are selling 199 for one piece. Now it is going in bundles. So it changes. Clear? So that is obsolescence of inventory is also a judgment based. You cannot directly say that this is going to happen. Clear? You are just judging that 10% of this might go waste. Waste in the sense not exactly the price which should have fetched. It is not going to fetch that price. Clear? Yes? Everybody is following? Okay. So again, the same they have given again: depreciation, provision for doubtful debt, warranty, provision for taxation. Provision for taxation is also an estimate, sir. Clear? So whenever we file income tax return, before that only the books of accounts of the company would have already been finalized, audited also. We would have made a provision for taxation, but what would have happened? Certain expenditure which was allowed under Companies Act might not be allowed under Income Tax Act. So that time whatever provision you made would have changed. Am I clear? Everybody? Yes? So those things are provision. Now next important or the last part of your chapter is accounting standards. Accounting. Now, accounting standards means what? The name itself says standard. What is the meaning of standard? Uniformity. Correct or no? We can say uniformity. So, what is the standard procedure of coming to class? Sir, you have to open the door, come in silently, sit in the class, listen to the class, finish the class, get out and go. This is the standard procedure. Like that, accounting also was in need of standard. Why we were in need of standard, sir? Say for example, if there was no need, say if there was no standard with respect to coming inside the class and going outside the class, what would have happened? One person would have come at 1, one person would have come at 1:30, one person would have said, sir, no mood, sir, I am going out. One person would have started talking in the class over the phone with his girlfriend or boyfriend. Correct or no? Whatever it is, n number of things. One person might have sit in the corner eating popcorn and cold drinks. Anything would have happened, right? If there was no standard. What was the standard? Now the standard is come, sit quietly, listen to the class, then finish the class. You go do whatever you want to do. Correct. Now, if the standard was not there, all these things would have happened. Similarly, in accounting, if standards were not there, what would have happened? Every company or every organization would have done accounting however they want. Sir, I want to show this item in P&L. Show. Sir, I want to show this item in balance sheet. Show. Correct or no? So, to avoid this complexity, to avoid this, sir, why we have to avoid? Sir, let them do whatever they want to do, sir. It's their life, their rules. Correct or no? No, sir, it is not their life, their rules. Lot of investors are betting on that company. Lot of stakeholders are, holding on to that particular company depending upon certain expectations. Correct or no? So, the first thing which usually the stakeholders do is compare it with other companies. If one company is showing P&L, one company is showing in balance sheet, how do you compare it? Correct or no? We can't compare it. So, that is why what we do, we first ensure that all the companies follow the uniformity. Clear? So, everybody should follow the similar thing. Then only we can say this company is going to, when we can compare both the companies and say this company is going to outperform this company. Correct? So, that is where they understood that we need uniformity in accounting. Because uniformity was needed, they prepared certain rules, and those rules are nothing but accounting standards. Again, remember, these are rules, but if you don't follow, they will not arrest you and put in the jail. They will not arrest you and put in the jail. Then what they will do, sir? Yesterday we have seen a full disclosure clause, CDCM. Correct or no? In full disclosure, what did it say? Disclose all the relevant and material information. Correct? So, what we should do, sir? You have not followed accounting standard, disclose it. That we have not followed the accounting standard. Explain as to why. Why you have not followed accounting standard? Is it because law was saying not to follow? Is it because of better presentation of financial statements? Is it because of uniformity and comparity in practice? What was the reason? Or is it because management didn't have the mood to adopt it? If that is the case, fine, you report that also. Clear? Yes? Sir, if I report like this, what will happen, sir? Investor will see, sir. Investor will say, we also don't have mood to invest in your company. Correct or no? Everybody is understanding? Yeah? Okay. So, accounting standard, why it was needed? Because they wanted to bring the uniformity. The reason for bringing the uniformity is comparability. Comparability between our financials first. Last year, or few previous years and this year. Or comparability between different companies in the same industry. Am I clear? Yes. So, to bring that uniformity, accounting standard was needed. So, what they did? They just created certain rules which should be followed by certain companies. Most of the companies. Clear? Now, sir, who did this accounting standard, sir? So, there is a body called as ICAI. Just like how there is So, this is Institute of Company Secretaries of India. This is Institute of Chartered Accountants of India. Now, what ICAI will do is, ICAI will first find out the areas in which rules are to be made. Sir, what do you mean by that? Say, for example, everybody is selling. One is selling goods, one is selling services. Correct or no? Or one might be selling both. Sir, how we can sell both, sir? Yeah, we can sell. Say, for example, sale of washing machine plus installation. Correct or no? Sale of goods plus sale of services, right? Anything. Sir, sale of AC plus installation. Correct? So one might be selling goods, one might be selling services, one might be selling both put together, right? So it might happen. That is also possible. So now what ICA said, see how they are recognizing revenue. One is in goods, one is service. Say goods fellow will recognize in a different way, service industry will recognize in a different way, mixed will recognize in a different way. So then when ICA said no, we need certain conditions or rules in this. So what they said, they introduced an accounting standard called as revenue recognition under AS 9. So under that standard they said, when we can recognize sale of goods, we can recognize sale of goods only when risk and rewards are transferred. It is a condition in your accounting standard. When we can recognize the services, when our performance obligation is completed. So they gave certain rules. So what ICR does first thing is, they will first find out the area where accounting standard is required. There is a need of certain uniformity. Once they identify the area, they give that area to ASB. There is something called as ASB. Example kelbodu 1 marks. What is that? What is the full form of ASB? It is nothing but accounting. Anybody? Accounting Standard Board. So what this board does is, this board will form a steady circle. What circle? Steady circle. So what is steady circle, sir? Whatever you have assumed, that is the steady circle. Like how, sir? Sir, we two friends will always sit steady together. That is a steady circle. Like that in accounting standard board also, what it says is, do one thing. In this area you want accounting standard is what ICI has told. ICI said we need accounting standard in this particular area, and they told to ASB. Now what ASB does is, ASB will form a study circle based upon the experts in that field. So in that experts, businessman can come, chartered accountant can come, company secretary can come, MBA can come, engineer can come. They form a group and they will ask them to study about this topic and prepare a draft standard. Clear? Once the draft standard is prepared, they give that draft standard to institute. That institute will, what they do, they go and give it to their members or the industry. Say, this is what draft we have prepared, give you a feedback. Give you a feedback. Clear? So once the feedbacks are collected, it will be again presented in front of ASB. Now accounting standard board will again take those feedbacks, and whatever feedbacks feels these are the things which needs to be considered, they will consider, rectify the accounting standard and reissue it again. Revise the standard and reissue it again. Now again, if the institute says no, this is correct, now let's approve this standard. Once they approve this standard, the Institute of Chartered Accountants of India will recommend this standard to Ministry of Corporate Affairs. That is specially your department, company secretary's department. So we recommend it. Earlier, before Ministry of Corporate Affairs, before NAFRA, there is something called as NAFRA. Clear? Before NAFRA was there, institute would have directly released the accounting standard in the market. Okay, but now the rules have changed. Now what they do is, institute will recommend it to NAFRA. See, these are the accounting standards. Now NAFRA will go through those standards, and then they will say if it is okay, they will release those standards. This is done for what? This is done for an organization which will get covered under Ministry of Corporate Affairs. Sir, which organization gets covered under Ministry of Corporate Affairs? Can you tell me? Which organizations get covered under Ministry of Corporate Affairs? Huh? No. Hey, ICSI is an independent body. It is passed in the Parliament Act. Under Ministry of Corporate Affairs, what all type of organization gets covered? The name itself says Ministry of Corporate Affairs. So that means what? Corporate andre yavadu? Private limited, public limited, LLP, Nidhi limited. Nidhi anta ondide. Nidhi, yeah. Nidhi limited is there. What else? Section 8 companies. One person company. correct? All this government company, correct? All government company is nothing but more than 50% of the shareholding. Dormant company, yeah. Government company is nothing but more than 50% of the share is held with the government. So it is also a public company only. Clear? So all these things are covered under Ministry of Corporate Affairs. What are those things?
Sir, is that foreign company comes under Ministry of Corporate Affairs?
No. Yeah. If it is having a presence over here, if they are having an establishment,
it is incorporated outside India.
That is what. If they have a subsidiary here, it will come. If it doesn't have a subsidiary, it will not come under the purview of Ministry of. That means they don't have to file annual returns to Ministry of Corporate Affairs. Clear? So there is something called as, for that only there is something called as, there are different provisions under Income Tax Act and FEMA. There is something called as POEM, Permanent Office Establishment, like that. There is this big concept. So if the company doesn't have any subsidiary company here, it doesn't have to comply with MCA with respect to compliance.
Sir, are they going to pay tax in our government?
Yes, sir. If they earn anything here, they have to pay the tax, no matter what.
Is that working accounting normal standards which are incorporated?
Yes. When any person wants to do any business in our country, it should follow our local law. That is the rule. Clear? Say for example, now Google sells Google ad, right? So if you observe carefully, if you have purchased anything from Play Store, subscribed anything in Play Store, it will come as Google Asia. That is a company set up in Singapore. So it looks after all the Asian thing. So when we sell something, they will collect GST also from you. Even though the company is not incorporated here, it will still follow the guidelines of our country. Clear? So whatever taxes rules are there, it has to follow. The only thing is it is exempted from annual return filing under Ministry of Corporate Affairs, provided it doesn't have a subsidiary. Clear? Yeah. So what happens now? Under Ministry of Corporate Affairs, what all is covered? Private limited, public limited, one-person company, LLPs. Correct? So accounting standard is recommended by ICI to NAFRA. NAFRA will issue the standards. Now what about other type of entities, sir? Sole proprietor, partnership, trust, society. Then what about them, sir? For them, institute will directly release the standards. Understanding? For them, ICI will only directly release the standards because there is no overlooking body. Correct? There is no body which takes care of all this organization. So institute only will directly recommend. Understanding? So if a client comes to me and is a sole proprietor, I should ensure that I follow accounting standard. Not because MCA has not prescribed, but ICI is prescribing. Understanding? Yes? Okay. So that is your accounting standard. So that is how accounting standard comes into play. So what ICI does is it will find out different areas, different standards for each area. So what is the purpose of that? The purpose is to arrive at uniformity, comparability, reliability. Correct or no? If there is a standard rule, you can rely on those financial statements. Correct? Comparability is achieved. Uniformity is achieved. Reliability is achieved. Correct? Yes? Okay. Now, accounting standard are actually three types of, just for your knowledge. One is our GAAP accounting standards. One is our Ind AS. The other one is IFRS. Now, what is GAAP accounting standards, sir? What is Ind AS, sir? What is IFRS? First, we'll start with IFRS. The full form of IFRS is International Financial Reporting Standard. What? International Financial Reporting Standard. Sir, what are these standards, sir? These standards are released by entire world's institutes put together. So, like how we have Institute of Chartered Accountant of India, there is Institute of Chartered Accountants of England and Wales. Clear? There is Institute of Chartered Accountant of Netherlands, Institute of Chartered Accountants of Australia. Understanding? So like that, Institute of Chartered Accountants of Pakistan. Like that, every country has their own body, which is independent in every country. Why we need to be independent? Because if government starts to influence us, then we will, whatever we sign, will lose the credibility. Correct or no? If government is influencing us in everything, then where is the question of independency? Correct or no? When we sign a financial statement, the users of that financial statement will think that I have independently verified this. Why independence is required? Simple, sir. If I am not independent, then I will be biased. Correct or no? Even though company is not performing well, I will say, no, company is performing well. It will be wrong. Correct or no? So like that, all over the world, independent bodies are there. Correct? So all those bodies came together and formed an committee or a group. Clear? Now that group prescribed this IFRS. Why, sir? What was the need of this group to prescribe IFRS? What happened was, post 2000 2008 era, globalization increased. That means Wipro was there in India also, Wipro is there in US also, TCS is there in India also, TCS is there in US also. So now understand, where Wipro's, what is the main country? India. But is it not doing business in the US also? Correct? No. Same thing happens with the TCS. Main country, where is the originating country? India. So like that, there are many number of companies which started to do business globally. Correct? Now, let us say one person from Dubai, say our Sheikh, wants to invest in one company. Now, that company is having branch in only India, but he is analyzing between two companies, TCS and one more company which is having only in India presence. But the turnover of both the companies are equal. Correct? But now understand, TCS say is preparing based upon the US figures also. Correct? Based upon the Indian figures also. Now let us say TCS, okay, let's change the example. Let's say like this. He has two companies. One is a company in USA, one is a company in Australia. Okay, for your better understanding, easy understanding. One company is in Australia, one company is in USA. Now the Sheikh is deciding where to invest. Australia will use its own standard, America will use its own standards. Now how can he compare both the companies? He can't. Correct or no? The rules in Australia is different, the rules in America is different. Now can we compare both the companies? No, it would have been difficult. It would have been complex in comparing. Again, he would have ended up going to 10 professionals to help him. Correct or no? So to avoid this, what the forum said is, we will release the standards which will be applicable to all the companies across the globe. So any company wants to go global and bring investors from anywhere in the world can follow IFRS. Now understand. Now Australian company is also following IFRS. US company is also following IFRS. Now can we compare it? Yes. Uniformity achieved? Yes or no? So the reason for IFRS was impact of globalization. Investor sitting in America is putting money somewhere in Nigeria. Correct? Investor sitting in China is investing somewhere in, say for example, is investing somewhere in Europe. Correct? So like that, to compare the things, because when I want, say I am an investor from India, I want to put money in TCS or I want to put money in Meta. How can I compare it? Only when I bring the two financial statement and see, then only I can say which company is better to invest. If there is no uniformity between preparation of financial statement, how can I compare it? I cannot compare it. Correct or no? So that is why IFRS was prescribed. But it is voluntary, sir. No compulsion. You can't say a private limited company which is operating in Mysore to follow IFRS. Why will it follow? Correct or no? Why will it follow? In simple terms, I am coming and asking you, from tomorrow if you want to come to class by driving bike, riding bike, you should get international license. What will you say? Sir, I don't go international, sir. I am unable to go outside Mysore only. Now you are talking about international. Correct or no? So like that, whichever company wants to pull the investors globally, they can prepare under IFRS. Now what is Ind AS, sir? See, Ind AS is 80 to 90% similar to IFRS. Sir, then why there was need of Ind AS? I will tell you. Certain principles in IFRS or certain rules in IFRS was not pretty much sitting correctly with us. Say for example, in US, everything runs on leasing, sir. Your mixer is also leased. which in our household purchase like anything. Hey, I get on Mixi. Today to Blinkit. You order Blinkit, Mixi will also come, everything will come. Correct? Yes. So, but there in US it is different. There everything is on lease. Your mixer is on lease, car is on lease, house is on lease. Your lawn mower is also on lease. Correct? Yes or no? So there, the leasing standard which is applicable to whatever IFRS has defined the leasing standard, it was more suitable to countries like US where everything is on lease, but that may not be suitable for us because in our country leasing is very limited. Where is leasing? Very less. Correct? This house lease which we talk about Mysore is not actually leasing. There is a concept in our Karnataka, Bogye Khakadu, correct or not? 10 lakhs you pay, you stay for 10 years. After 10 years, they will pay you back 10 lakhs. That is not exactly typical leasing. Leasing is nothing but rent only, sir. Leasing is the word which is used for rent. It is more of a financing arrangement. Clear? So we don't have to, as you rightly said, in our country, leasing means what? 10 lakhs you pay, stay 10 years, after 10 years, take 10 lakhs and go back. This is not there in US. Correct? So we needed, of course, leasing is there. Yes, leasing is there. But is it similar to US? No. Little bit different. Leasing concept is there, but work differently. So what we did? Okay. IFRS we need, but we'll do one thing. What is not needed, we'll remove. What is needed, we'll bring in. So we call it as carve in and carve out. So we will remove, we will add. That's it. So IFRS is nothing but, Ind AS is nothing but adoption of IFRS, but with certain modification. Carve in, carve out. Clear? Now GAAP, it was old accounting standard, which is still followed today by private limited companies and sole proprietors, partnerships, all those things. So this Ind AS is recommended only for MCA. That means your private limited company, public limited company, and your what else? OPC, all those things. But they have a condition. If you achieve so and so turnover, or if your turnover is this much, or your net worth is this much, then only you have to follow Ind AS. Otherwise, you follow normal accounting standards. Normal accounting standards. Clear? Yes. So these are the three types of standards. One is our normal GAAP accounting standards. The one is Ind AS. The other one is IFRS. IFRS are international. This too belongs to our country. But Ind AS is just a replica of IFRS with carve in and carve out. This is applicable only to corporate entities. That too with certain limits. This is applicable to rest everybody. Clear? So in this, what are the corporates that are covered? Your private limited company, public limited company, listed company, non-listed company, everything will be covered, provided there are certain criteria. If you fulfill that criteria, you have to mandatorily follow Indian accounting standard, that is Ind AS. If you don't fall under those criteria, you can follow your normal GAAP accounting standards. Am I clear? So what are the objectives of accounting? Uniformity, transparency and comparability, reliability, protection to the stakeholders, and true and fair view. Clear? So again, the same thing is repeated. One more point is global integration. What can be the limitation of accounting standard? Can anybody say? Say for example, I say you have to come dressed like this only to the class. First day will come. Say I have given you one rule. You have to wear daily jackets to the class. That is the rule. You came wearing jacket 1 day, 2 day, 3 day, 3rd day, 4th day, 5th day. Suddenly it is very hot. But I'll say, no removing jackets. You have to wear the jackets only. What will happen to you? What kind of sir is so irritating? Correct or not? It's so irritating. Why does he need, whether we need to wear jacket or not? It is our personal choice. But did I give you a personal choice? No. I didn't give you a personal choice. So what happened to you? You felt sir is very strict, very irritating. He will scold if I don't wear a jacket. So in other words, can I say sir is very rigid? Correct? So accounting standards are also like that. They can be rigid sometimes. Even though that rule doesn't, now right now we are dealing with that rigidity in one of our client actually, which we are auditing. The client's turnover is 400 crores. Clear? Now the client is into, they are basically a electrical infrastructure company. So they take government orders, correct? So now the rigidity is, there is something called as accounting standard 7. We are saying accounting standard 7 is applicable, but the earlier auditor is saying accounting standard 7 is not applicable. Now he looks from his point of view, I look from my point of view. Now if you look carefully, accounting standard 7, it applies to them. But again, I myself will say, looking at the company's way of operation, I say accounting standard 7 as per the standard it is applicable, but if I look deeper in the company, AS7 is not applicable. So I agree with the earlier auditor also, I agree with me also. Clear? So I can't say earlier auditor is wrong. His justification is also correct. My justification is also correct, because my justification is purely coming from AS7 standard. Correct? Purely coming from AS7 standard. Now what is happening here? Rigidity. Understanding? One is rigidity. Second is judgment. Correct or no? My judgment not applicable. His judgment applicable. Yes or no? So this can be our limitation. Correct? So what will happen, sir? Then what he will do, sir? I also don't know. We are still discussing. So whatever it is, then what we'll do? We'll pick some industry companies. What they are doing, we'll understand. There also we got confusing answer. One is following, one is not following. So what to do, sir? I will do one thing. I will do whatever at the end of the day. If I say I will not follow, I will mention it very clearly in my audit report. I will mention it very clearly in the notes to accounts that we are not following this because we felt it is not suitable to us. I told you yesterday, disclosure, whatever is relevant, disclose it. Understanding, everybody? So it can be rigid and it involves professional judgment. Now tell me, if this question comes, no, AS7, AS9 between me and the earlier auditor. Now I send you as an article. You do the argument with the earlier auditor. Will you be able to argue? Sir, I am in my second year of article. I don't know what is accounting standard only. I passed somehow in exam by doing rectification. How will I know, sir, what is accounting standard? Correct or no? So what is required, sir? It is, I as a chartered accountant only has to go for argument because I am trained in this. I have skills. You will also be trained and skilled once you clear the final exam. Correct or no? So can I say it involves skilled person, or can I say it is costly affair? Because sending an article, sending a CA, both time and the value for the time is different. I spend 1 hour in a place, I get remuneration for that 1 hour. Article spends 1 hour in a place, no remuneration. Correct or no? That is the truth, harsh truth. Yes, correct. So can I say it can be costly affair? Yes, it can be costly. Clear? Everybody is understanding? Next, there can be difference between local laws and global standard. Just now we discussed leasing, America. Correct? So those are your limitations. Am I clear? So these are your accounting standards. Valuation of inventory, cash flow statement, all those things. Sir, should we remember this? No need. They are just given for your knowledge. So you read it once, you understand. So just read the names so that you understand what all areas are covered for accounting standards. Here, AS7 construction contract, AS9 revenue recognition, AS10 property, plant and equipment, which we'll discuss about depreciation and revaluation. Clear? AS11 effects of changes in foreign exchange. Say when I sell my goods to foreign company, the transaction happens in foreign currency. How to bring it to Indian currency? What exchange rate should I use? How to account those things? Accounting for government grants, accounting for investments, accounting for amalgamation, employee benefits. Employee benefits is nothing but salary, retirement benefits, leave encashment, all those things. Borrowing cost is nothing but loan which we have taken. Segment reporting. Say a business can have multiple segments. So for example, Reliance can have FMCG, Reliance has supermarket segment, Reliance has wholesale segment, Reliance has telephone segment, Reliance has refinery segment. Correct or no? So lot of segments are there. Segment reporting says you report the profitability and the transaction of each segment separately. Clear? So like that, your accounting standard will continue. And this is your list of Indian accounting standards. Ind AS 1, Ind AS 2, Ind AS 3. So, sir, Nadakili Ind AS 3 missing, sir. There is no Ind AS 3. Why, sir, Ind AS 3 is not there? Because IFRS 3 was not there. Understanding or no? That is why we made it as, we skipped it. Clear? Or that standard might be in drafting. IFRS 3 is there, but we are drafting that standard. So that is why it is not yet notified. Like, so we strictly followed what was there in IFRS just to show that we can remember the numbers. Sir, do we really have to remember the numbers? 100% yes, once you become professional. Sir, no, sir. Once you become professional, no, you will automatically remember everything. Now I can tell accounting standard till 30, I can tell without looking at it. Clear? So like that, when you keep using it, you will start remembering it. There is no big deal. Yeah, AS 18 is related party, AS 19 is EPS, AS 20 is. So I can keep going on. How AS 19 is this, AS 20 EPS, AS 21 I'll say something else. I can go on. Why I can say? Because we use it in our day-to-day life. When we use it in our day-to-day life, we remember. Yep. So not now. Not now is the stage for you to by heart the things. But once you reach that stage, you will remember. Yep. Okay. So that completes your chapter 1. Now shall we go to chapter 2? Yes. Now comes your major chapter, a crux chapter, either make or break chapter. Correct or no? Either you will make out of it or you will break out of it. Correct? Why, sir? Because in this chapter we are going to learn your debit, credit, what are the books, what are the rules, how do we follow, how do you do it. Yes, all those things is covered under chapter number 2. So if you catch hold of this chapter, you will be through the subject. You will be through till professional also. No worries. Yes. So let's start this chapter. Now, before we start, we'll just quickly revise the things, what we done in the first chapter so that we don't forget. What is the definition of accounts, Appa? Definition of accounts. Process of or art of recording, classifying and summarizing the transaction and interpretation of transaction. Next, what is the scope of accounting? Recording of transaction, classifying, summarizing, interpreting. Next, what are the objectives of accounting, Appa? Recording, then profit and performance evaluation, financial position, financial performance, taxation, compliance with the law. Correct? Yes. Now we discussed various concepts, right? What are those? Business entity concept. Business is different, owner is different. Correct? Next, going concern. What do you mean by that? A business will continue its operation for foreseeable future. Yes. Next, money measurement concept. What is that? Sir, every transaction can be measured only in terms of money. Which cannot be measured in terms of money has no place in the books of accounts. Feelings, no place. Correct? Next, accrual concept. What does accrual concept says? Record the revenue as and when it is earned, record the expenditure as and when it is incurred. Dual aspect concept. What does it say? Every transaction has two legs, debit, credit. Clear? Next, cost concept. Yeah, cost concept. Record all the transaction at the cost at which you have acquired a particular asset or a transaction. Clear? Next, money measurement done. Periodicity concept. So every transaction or every financial statement is prepared based upon a particular period. In our India, we follow a financial year method from April to March. That is 12 months. Clear? Matching concept. Consistency concept. What is matching concept? Every income will have a expenditure, but every expense will need to have a income. No. Yes. Next, consistency concept. Every year we have to consistently follow the accounting policies. If there is any change, we can change it only under 3 circumstances. What are those 3 circumstances? Prescribed by the law or standard, better presentation of financial statements, and industry practice. Yeah, that's what. For if industry practice, it is better for comparability, then we can change it. Clear? What overrides? Law or standards? Law will always override the standard. Prudence.
Anticipate all the loss.
Don't anticipate any profits. Next. Realization concept, good. Yeah. What is realization concept?
In the sense,
When the transaction is actually realized, please record it. Clear? Next, what is the next apa? Conservatism. Conservatism we did. Prudence. Materiality. All the relevant and important information which can impact the users of that particular information should be provided or disclosed. Clear? Yes. Or one more way is any information which is relevant and important for a decision making purpose is called as material information. Clear? Next. Those will principles. Full disclosure meaning what? We have to disclose all the relevant information and material information. Clear? Next. What are the components of financial statement? Balance sheet, P&L, cash flow statement, notes to accounts. Correct? Next. Qualitative characteristics of financial statement. Understandability, reliability, relevance, comparability. Clear? Yes, these are the qualitative characteristics of financial statement. Accounting policies are group of all the practices, principles, rules and all those conventions. Yes. Clear? So today's class also we have already discussed the further how accounting standard is done, all those things. So that is your first chapter. So what will come in first chapter? Most probably theoretical question only should come. 5 marks. Clear? So let's move to the second chapter. Now, so second chapter basically covers the way you do the accounting entries. How accounting entries are done. So before starting that, yesterday we discussed two definitions. What are those? Assets and liabilities. What is assets? Resource controlled by the entity from which future economic benefit inflow is expected. What is liability?
it's an obligation.
Obligation arising from past event on settlement of which future economic benefit outflow is expected. Clear? Now before we learn accounting, first we will understand categorization of any transaction into 5 items. What are those 5 items, sir? Assets, liabilities, expenses, income. Let's try to understand this 5 items. If you get hold of these 5 items, your accounting will become easy. Correct? So we have already seen what is asset, what is liability. We want to know what is expense, what is income. Correct? In layman language, income means what, sir? Anything where we earn revenue. So in a technical world, we can say inflow of economic benefit which is not done by the way of contribution by the owners. Sir, sir. One is first we'll take inflow of economic benefit. So inflow of economic benefit, what it can be, sir? Give examples. Sir. Sales. Is there inflow of economic benefit? Yes. You are selling the goods, you are getting the receivable or you are getting the cash. So inflow of economic benefit is there. Yes, sir. First part is clear, sir. Second part, sir. Other than by way of contribution by the owners. What do you mean by that, sir? So, say I started a business. I contribute the money to the business. It is also called as inflow of economic benefit only, no? Because look from the perspective of business. Business is getting the money from the owner. Correct? It is also inflow of economic benefit. Correct or no? Why? Because business is getting cash. They want to keep this outside. That is why they use the word inflow of economic benefit excluding any contribution by the owner. Clear? Because any contribution by the owner is not a income. It is a capital contribution. Everybody is following? So income means what? Inflow of economic benefit, but excludes any inflow of economic benefit by the way of contribution from the owners. Clear? Now coming to expenses. What is expenses? Outflow of economic benefit except or excluding outflow of economic benefit to the shareholders or to the owners by way of distribution. By way of distribution. Now first let's understand the first part. Outflow of economic benefit. Sir, when I am paying salary, is my cash or bank is going out? Yes or no? So economic benefit is going outflow. Correct? That understood, sir. Now come to second part, sir. You said excluding outflow of economic benefit by way of distribution. What is the meaning of this? Now understand. Earlier case I said owner will come and put in the money. Now let's take second example. Owner is taking the money from the business. Now this is also economic benefit outflow. Correct or no? This is also economic benefit outflow. But is it an expenses? Answer is no. It is not a expenses. So as we told, it is not an expenses. So that is why we want to exclude it from the definition of expenses. So how do you exclude it? First put the condition. What is the expenses? Outflow of economic benefit excluding any outflow of economic benefit by the way of distribution to the shareholders or to the owners. So if any economic benefit outflow is happening, but it is to the shareholders, then don't take that as expenses. That will again go as capital distribution or drawings. We call it as drawings. Is everybody understanding? Understood what is income, understood what is expense? The second part is very important. Okay, income means inflow of economic benefit excludes any contribution in the nature of economic benefit by the owners. Expenses, outflow of economic benefit, but excludes any outflow of economic benefit to the owners by the way of distribution. Clear? Everybody? Say, best example for this. Dividend. You know what is dividend? A dividend is a share of profit given to the owners of the company. Who are owners of the company? Shareholders. Correct? So shareholder will get their share of profit by the way of dividend. Now understand. Is it outflow of economic benefit when I pay the dividend? Answer is yes. But come to second part. It excludes outflow of economic benefit by way of distribution to the owners. So shareholders are owners. Are we distributing a profit? So is it an expenses? Answer is no. It fulfills the first point, but it doesn't fulfill the second point because it falls under the second point. So that is why dividend will never be treated as expenses. Dividend will be treated as distribution of profits. Understanding everybody? Yes? Are you guys following? No doubts? Okay. Now that is your income and expenses. Capital you already understood. Any contribution on any distribution or drawings from the owner will come under capital. Clear? Any contribution by the owner or any drawings from the owner or any distribution of profits to the owner will come under capital account. Clear? Yes? Now, everybody is clear about this assets, income, expense, all those things. You want any more examples? Expenses, rent. Sir, why rent is an expenses? Outflow of economic benefit. How? Because we pay the rent. When we pay the rent, money is going out. Salary, again, going out. Correct? Then what else? Interest expenses. Money is paid to the financial institution like banks, NBFC. Correct or no? So economic benefit is outflow. Correct? Yes? Understanding? So assets, liability, income, expenses and capital. Now why we have written like this, sir? Why we have written like this is because today I am going to explain you when debit, when credit. Clear? And this method which we are going to follow today is called as modern method. Clear? Modern method. So always remember why this method I teach to students is it is easier to understand. Any background you come from science, commerce, arts, whatever you come, this is the most easiest method to understand. I myself, I come from a science background and it was easy for me to understand. Clear? Yes. Now, simple rule appa. If any of these two increases, it will be debit. If any of these two decreases, if any of these three increases, if any of this decreases, stay. Rule is simple. If these items are increasing, it will be debited. If these items are decreasing, it will be credited. If these items are increasing, it will be credited. If these items are decreasing, it will be debited. This is the rule. First you read the rule, understand it. First group assets one kade, expense one, both same group. Other group will be income, liabilities and capital. Clear? Asset side group, increase debit, decrease credit. Liability side group, increase credit, decrease debit. If you remember one also, the other one is easy to remember. Correct or no? Why exactly opposite? Correct or no? Yes. If you remember one, the opposite. The other group is the opposite. Now let's understand this, how we use these rules into our day-to-day transaction. Let's say I purchased goods worth 10,000. By paying 10,000 in, clear? What are the two legs of transaction? Purchase of goods, payment, two legs, correct? So debit, credit. Now, what is purchases? Is it an asset? Is it an expense? Correct. But first understand and fit the definition. I know you guys have biated purchases since the first PUC of commerce, correct or no? But let's understand where exactly the purchases fits into the definition. Is purchase an asset? Let's say purchases. Okay, what is the definition? Resource controlled by the entity from which future economic benefit inflow is there. Anything like that? Clear? Immediately economic benefit outflow is there. Correct or no? Yes or no? No, sir. Future economic benefit inflow is also there. That is stock, not purchases. First you do purchase, then it will come and add to your stock. But we are looking at stock, we are looking at purchases, we are looking at purchases. First, what will happen? Economic benefit outflow. Correct or no? Yes. So it will classify as expenses. Everybody agrees? No, sir. It will get classified as income. Where, sir? Is there an economic benefit inflow? No. Outflow is there. Correct or no? So first thing is purchases is a expenditure. Okay. Now my next question. Is expenditure increasing or decreasing? When I purchase the goods, whether my purchases will go up or come down? Will go up. So where does it fall? Here or here? It is an expenditure. So when expenditure goes up, what it should be done? Debit. So purchases is going up. So we need to debit. Yes, sir. First leg of the transaction is recorded. Purchase of goods recorded, sir. Next, from where we are making the payment, sir? Bank account. Now, what is bank account? Asset, liability, income, expense. Let's take example. Asset. Asset is a resource controlled by the entity from which future economic benefit inflow is expected. Now, put the definition into the bank. Bank is a resource controlled by the entity. Not the bank means entire bank, my bank balance. Correct? It is a resource controlled by the entity from which future economic benefit inflow is expected. That means what? I can convert it into cash. I can purchase something from that bank balance. Correct or no? Yes, so it is an asset. Now, whether my asset is going up or coming down. When I make payment from the bank account, whether my bank balance will go up or bank balance will come down? Come down. So when asset comes down, it should be step. That's it. Sir, one fundamental rule you should remember. First, always debit will come, then credit will come. Now, don't write credit first and debit later. That will never work. This is one rule you have to remember. Debit should come first, then will credit come. Clear? Sir, if the same transaction, what if we have done in cash? Simple. Same entry will remain the same. Purchase account debit to cash. Cash is also an asset. When asset decreases, credit. Sir, how cash is an asset? Sir, resource controlled by the entity from which future economic benefit inflow is there? Yes, it is there. We can purchase something from the cash, correct or no? Yes. So this is the entry. Sir, what if we have purchased on credit? From Mr. B. Correct? Okay, let's see. Purchases account debit antu idde irutte. Correct or no? There is no change here. Now here is only change. Now who is B? He is a asset, is a expense, income, liability. First question, is he a asset? Let's check. Resource controlled by the entity. First of all, can you control Mr. B's balance? Can you say I will not pay you and he will leave you? He will come and sit in your house only. Correct or no? So he is not an asset. Next, come to expenses. Economic benefit outflow. B, just because of B, there is no economic benefit outflow. Economic benefit outflow happened because of purchases. Correct or no? B is not the reason why economic benefit outflow is happening. Correct? Oh, that also doesn't fit. Next, let's come to liability. It is an obligation arising from past events. Are we obligated to pay to Mr. B? Yes. For what? What is the past event? Purchase of goods. Now, on settlement of which future economic benefit outflow is expected. Correct or no? So, what do you mean by this, sir? When I pay B, my cash will go out. So, future economic benefit outflow is happening. Clear or no? Yes. So, B fits the definition of liability. When liability goes up, comes down. B now goes up. B, we have to make payment. Till now, B's balance was 0. Now, when we purchase goods from credit from B, whether his balance will go up or come down? Go up. So, when liability goes up, debit or credit? Yes, everybody understood. Any doubts in this? No doubts? Pakka? All good? Now, next, very, very important, always confusing. Journal entry. Now, my question to you. First, furniture. We are purchasing the furniture. Now, my question, whether this furniture is an asset, income, expenses, liability. Asset. How, sir? Furniture is a resource controlled by the entity from which future economic benefit inflow is expected. Sir, furniture in the ಏನು future economic benefit inflow ಇರುತ್ತೆ, sir? Sir, I am a CA officer. If there are no furniture, clients will not come to my office. Where will they sit? On my head? No, right? They need a place to sit and explain their case. Correct? They need furniture to come to my office and sit and explain me the things and get the work done from me. If there are no, for let's say there is no this table, how will I sit? Correct or no? Not possible. One hand laptop, one hand mouse. Mouse where should I keep? Like this I should do only. What else is remaining? Correct. So furnitures are needed. Why? Because by using that furniture, I can earn money. If my office is like this, why will client come to me? He doesn't have a proper place to sit also. Why should I go to him? Correct. So how future economic benefit inflow is happening? Because of the furniture, client will come and sit. And because he comes and sit, I earn my bread and butter from him. Clear? Yes. So furniture is a asset from which future economic benefit inflow is expected. And it is a resource controlled by me. Correct or no? I can throw it, I can keep it, I can replace it, I can sell it. Correct? Yes. So furniture is an asset. Certain people will say, no, sir, furniture will also considered as purchases. Why? Economic benefit outflow. Correct. Economic benefit outflow is there because of purchase of furniture. But is that economic benefit outflow only once? Whether furniture I will use it only, I purchased, I kept, one person sat on that, second moment I will throw it along with him. Yes, outflow, economic benefit outflow is there, I agree. But is it one time economic benefit outflow? I will keep, and of course, when I purchase, there is economic benefit outflow. But by using it, will I generate more and more economic benefit inflow? ಹೌದಾ ಇಲ್ವಪ್ಪ? I generate more and more economic benefit inflow. Correct? So that is why, of course, it fulfills the definition of purchases, expenses also, but it is fulfilling the definition of asset also. Correct? Yes or no? So whenever it is fulfilling the definition of asset, it is going to be classified as a asset. Clear, everybody? So expenditure can be two types of capital expenditure, revenue expenditure. This purchase of furniture fulfills the expenditure definition, but under that, will it fulfill capital expenditure, revenue expenditure? It will fulfill capital expenditure. That is, capital expenditure is nothing but asset definition. Understanding? So now don't buy heart the things. Sir, furniture from college days we have decided. Computer, furniture, chair, table, put together, sir, fixed assets. Correct or no? No need to buy heart. Understand the breakup. It is qualifying as an expenditure, but what type of expenditure? Capital expenditure or revenue expenditure? Now capital expenditure definition is what? Non-recurring in nature. Revenue expenditure definition is what? Recurring in nature. Now will you purchase furniture every day? Or will you purchase once in 3 years, once in 2 years? Correct or no? So fulfilling the definition of expenses. Now fulfilling the definition of capital expenditure. Now once it fulfills the expenditure definition of capital expenditure, non-recurring nature, check the definition of assets. Fulfilling the definition of assets, so it will come as a asset. So what is the entry? Furniture is an asset. That is concluded. Now furniture going up, coming down. Furniture balance is going up or coming down? Going up. We have purchased, no? Earlier there were 0 furnitures, now we have 1 furniture. So when asset increases, it will be correct. How did we purchase? By paying cash. Cash is also an asset. Now cash is going up or coming down? So it will be following, everybody. Now I will twist this question. The twist is same question, but I am dealer of furniture. Dealer of furniture means what? I sell furnitures. Now what will be the entry? First, no, I'm not selling. I'm just saying I'm dealer of furnitures. Transaction remains same. I purchased furniture worth 10,000 rupees by paying cash. Now understand. Will it fit the definition of expenses? Yes. Will it fit the definition of capital expenditure? Non-recurring in nature? No. It is recurring. I purchase regularly furniture and I sell. So suddenly it became revenue expenditure. So when it becomes revenue expenditure, no question of going to asset definition. Correct or no? It is a expenditure only. So immediately it will become purchases. The second part remains. Understanding, everybody? Yes, am I clear? Any doubts in this? You want to copy it down? Quickly copy it down. Done? Copied up? Online students can just take a screenshot maybe. Right? Yeah. Now, what else we discussed about this? Assets, liability, and this everybody copied? Yeah. Okay. Now, this is modern method of accounting. Now there is something called as traditional method of accounting. So what is traditional method of accounting? We'll quickly discuss, because of course it is there in your syllabus. I have to discuss that. My suggestion for students when it comes to traditional methods of accounting, understand for a moment, forget it. Follow modern method of accounting because it is easier than traditional method of accounting. I know whoever has joined from commerce background, they say, no, sir, we are very much good with traditional method of accounting. My question is, in exams, you will be having lot of stress and tension. You don't know whether to classify under real law, nominal law, or personal. Correct or no? You are troublesome. So that is why follow simple assets, expense, income, liability. Now, when you keep solving the sums, no, you don't have to every time decide about the definition, whether this will go under assets, if this will go under income. No. As and when we keep solving the sums, by looking at the name itself, we will say, this is an income item, this is an expense item, this is an asset item, this is an liability item. Understanding? So that fulfilling the definition criteria is only in the beginning. Once you understand that, you don't have to fulfill it. But illangalla, every time you have to decide whether it is a personal, real, nominal, correct or no, what comes in, what goes out, all those things. So traditional method of accounting is split into three parts. One is real account. Other one is one more. Yes, sir. So traditional method classifies your rules into three things. These are also called as golden rules of accounting. Clear? Golden rules of accounting. So they split the things into three items: personal, real, and nominal. Now, what is personal, sir? Personal again is split into three. What is that? Natural, artificial, representative. Artificial, natural, and representative. What is natural, sir? I, you, all the human beings present is all natural. Now, what is artificial, sir? Company, private limited, public limited, trust, partnership firm, LLP, all these things are artificial. Sir, what is representative? It represents a particular group. For example, sir, salary payable. Correct? Salary payable represents the entire group of employees. Correct or no? Yes. So salary payable includes the group of entire people. Or rent payable. So it represents whom? Landlord. Correct or no? Rent payable represents whom? Landlord. Instead of using name of the landlord, I am using rent payable. So it is representing whom? Landlord. Now, the rule of personal account is, tell me. Huh? Debit the receiver, credit the giver. Debit the receiver and credit the giver. Let's not see the transaction now only, because after seeing all the rules, we have to integrate between 2-3 rules and record the transaction. Clear? So it is not that one rule I will use to record all the transaction. It doesn't work in that in traditional method, which actually works in modern method. Increase, decrease, it will work. Correct? Huh. Next comes our real account. What will come under real account? Tell me. Assets will come under real accounts. Clear? What type of assets are? Fixed assets, tangible assets, intangible assets, debtors, cash, bank, everything will come under real account. Yes? Now, what is the rule here? Debit what comes in and credit what goes out. Correct? Yes, this is second rule. Now, the last, nominal account. Expenses, income, losses and here debit all expenses, credit, of course, and losses, credit all income, and the last rule is similar to our rule. Correct or no? The last rule is similar to our rule. Now, understand carefully. Sir, nominal account will cover expenses, income, losses and gain, debit all the expenses and credit all the income. The real account says it will cover assets. So, debit what comes in, credit what goes out. Personal account says debit the receiver, credit the giver. Now, let's same transaction if we record using the traditional approach, how it will be done. First one was what, Appa? Purchase of goods worth, am I right? Purchase of goods worth 10,000 by paying in bank. Correct? Now, purchase of goods is an expenditure. Correct? So, what your definition of expenditure says? Debit all the expenses. So, purchase account debit. Correct? No. By paying from whom? Bank. Correct? Bank is what, Appa? Asset. Asset rule ಏನು ಹೇಳುತ್ತೆ? Debit what comes in, credit what goes out. Your bank balance is going out or coming in? Going out. Why? Because you will transfer the money to somebody else. So your bank balance will, the money in the bank will go out of the bank. Correct? So, clear? Is everybody clear? Yes? Sakapa. This is enough. I wanted to explain what is traditional method, I explained. Now, no more traditional method. This is just for your knowledge. If question comes for 3 marks or 5 marks, explain golden rules. You have to explain what is real account, what is nominal account, what is personal account, what are the types of them, then write the rule. Am I clear? So, if it comes, it should come for 5 marks. So, why I explained? To get the 5 marks. Going forward, which method you will follow? You will always follow till lifelong, till our last breath. Clear? Now, coming to next point of discussion, there are different types of books in accounts. Clear? The first book is called as journal. What it is? Journal. Now, what is this book, sir? Journal is a book where we record all the transactions. Understanding? We record all the transactions. In simple words, if you go to a kirana store near your home or a pharmaceutical, whatever it is, very small one, they would have maintained one book where they would have written all the transactions. Today I sold this much, I purchased this much, I purchased from so and so, I sold to so and so on credit. Correct or no? So, journal is something in which you record all the transactions. Clear? How the transactions are recorded, sir? Transactions are recorded in a chronological order. What do you mean by chronological order? Chronological order is nothing but it is recorded as and when the transaction is happened. That means, say for example, first I purchased goods, next I sold the goods. How you will record? First you will record the purchases, then you will record the sales. In the order or in the sequence in which transaction has happened, in that sequence or order only you will record the transaction in journal. Clear? Everybody is following? So, who can maintain journal? A bookkeeper can maintain journal. Correct or no? Skill, technical knowledge, that much is not needed. Record all the transactions at one place. Clear? So, that is your journal. So, journal can also be called as primary books because source of information for further classification is depending upon the transaction being recorded in the journal. Correct or no? Source apa. It is a source. From that information only we will definition, recording, classifying, summarizing. Recording is happening in the journal. So it is a source. Source for what? Source for classifying and summarizing. Clear? So that is your journal. Clear? Now, once we record in the journal, what next, sir? What next? Now, let us say in one page of 100 book, 100 pages, one book, I have recorded sales, purchases, salary, rent, all the things in one shot. Now, you are a businessman. You want to see how much profit you have earned. Can you do it? How we will do it, sir? Because that book doesn't have any balance. Every transaction is going there. Correct or no? Just like how whatever, whenever we go for malls, for food court, whatever is there in the stall, it will go in our stomach. Like that, every transaction is going there. Correct. Now, if you want to analyze as to what has happened, how much sales has happened, how much purchases has happened, how much expenditure has happened, how much profit I am making, to know these figures, you have to sit and analyze. Correct. But how do you analyze, sir? Is there any process? Is there any way we can analyze? Yes. There is a process called as posting. Sir, what we do in this posting as a process? See, from journal, we post the things to different books called as ledgers. For example, purchase will be put in purchase ledger. Sales will be put in sales ledger. Salary will be put in salary ledger. Rent will be put in rent. Cash and bank will be put under one ledger. Understanding, everybody? Yes. So what we did, first we recorded all the transaction in journal. Then from there we posted it to books called as ledgers. Clear? Everybody is understanding? Yes. So what does this ledger do? This ledger classifies the transaction. It classifies the transaction. Clear? So it classifies into different heads. Now can you say how much sales, how much purchase you made? Yes. Easy to say, because how much sales I made, go to sales account. How much purchase you made, go to purchase account. But sir, how much profit I made? Again, there you cannot directly arrive at figures. Correct or no? Yes. By just because now you have segregated into different books. But if I straight away ask how much profit I have made, you have to again take the calculator, sales minus purchases minus rent minus other expenses, then it will get profit. Correct or no? Not enough information. So what I will do, next I will do is from here, the next step is, what is the definition? And prepare what? Trial balance. So trial balance is the place where I will get total figures of everything. Sales total, purchase total, cash total, expense total, rent total, for example, rent expenses total, salary expense total, everything total figures I will get. Clear? So trial balance is a place where I will get everything in one shot. You remember your pocket money? All put in one page. That is trial balance. From that trial balance, I prepare here. You can understand what is profit. Here you can understand what is position. Understanding? By looking at this, you will interpret the way your business is operating. Fulfill the entire definition. Art of recording, classifying, summarizing and interpreting. Clear? Everybody is understanding? I hope, is it clear? Yeah. Now, what else was remaining? I was about to tell something. Now here, journal is recorded in chronological order. But here ledgers are recorded in, understand sir, ledgers are recording in analytical order, but under each ledger, chronology is followed. Under each ledger, chronology is followed. Say for example, I sold goods today also, I sold goods tomorrow also. In sales ledger, I cannot write sold goods tomorrow first, then sold goods today. No. First I will write sold goods on 7th. Then I will write sold goods on 8th. Clear? And inside each ledger, again chronologically it is followed. But when you prepare ledger, posting as a process, if you see, it is analytical in nature. You analyze, right? This is sales, you push it to sales. This is purchase, you push it to purchase. You see expense salary, you push it to salary. Clear, everybody? So April month salary will be recorded first. Then July month salary will come. You cannot record July month salary first in salary account, then April month. No. Clear? Inside the ledger, chronology is again followed. But from journal, while posting to ledgers, it is analytical order. Yeah, is everybody understanding? Any doubts in this? Okay. Now, this is how your journal entry looks. Clear? Now, let's see how your ledger accounts looks. Say, for example, let's take sales account. So, how does your ledger look? Simple T shape. What shape? T. Okay. In the T shape, there is one column here, one column here. Here we write amount. Here we write particulars. Clear? This side we call it as debit. This side we call it as credit. Clear? Okay. So this side we use buy. This side we use to. These things you have to remember only. There is no rule. This is the rule. On the credit side we use buy. On the debit side we use to before writing anything here. Clear? This is totaled. This is totaled. Always remember, one side there will be imbalance. Andre, here it can come 100. Here it can come 100. Here it can come 50. But accounts, one rule. What is the rule? Debit should always be equal to credit. Not like how you match your trial balance in PUC. Whether it doesn't match also, strike it, write 100. Suspense. Correct or no? Not allowed. Of course, your balance will needs to be always matched. So here it should be 100. Now whatever difference amount is there, that will come wherever the difference. Say here it is the difference, then it will come and sit here. It will be either transferred to P&L or it will be balance carried down. Clear? Now for which balance carried down, for which transfer to P&L, listen to me carefully. Your income and your expenses should be closed in that year only. Your income and expenses will be closed in that year only. That means there is no carry forward concept. Your income and your expense is for that particular year. Correct or no? So what you will do? Whatever balance is coming, that will be transferred to P&L. Correct? The reason why you are preparing P&L is to know what is income, what is expense, what is the profit. Correct or no? So all the income will go to P&L, all the expense will go to P&L. So whatever balancing figure you get, it will be transferred to P&L. But your assets and your liability, what? So your income and expenses will be transferred to P&L. Your assets and liabilities will be carry forwarded. So what is the meaning of this carry forwarded? Sir, let's take example of furniture. We took the furniture, correct? We closed the furniture account. Now, what is the meaning of this carry forwarded? Are you not using that furniture next year also? Correct or no? In the similar way, in books also, the furniture should come to the next year. In business, how in real life the furniture is coming to the next year, in books also it should come to the next year. Correct or no? So that is why assets and liabilities will be carry forwarded, income and expense will be closed and transferred to P&L account. Clear? Everybody is following?
When it comes about
Monthly
monthly recording,
recording, it depends, sir. If you want to carry forward it, you can carry forward it, but usually when they ask you to prepare, they will not ask you to prepare monthly recording. So yeah, so monthly recording, people may say two balance carried down when it comes to income and expense account. Because see, monthly recording, if you are doing it, you are doing it because you want to prepare MIS reports, management information system report. So when you are preparing MIS report, you want to prepare P&L. When you want to prepare P&L, you have to transfer it to P&L. Understanding? So yeah, left to you, but my choice is always transfer it to P&L. So income and expense will be transferred to P&L, assets and liabilities will be carry forward. Now next question, important question. Sir, you said there will be always imbalance, no sir? Correct. So what type of balance will always be there? Andre yav side balance usually will be higher. For asset and for expenses, it will always have a debit balance. For income and expenses, it will always have a credit balance. Sir, can you please explain with the example? Sure. Say we paid salary. We paid salary. By cash. So what is the entry? Two legs of the transaction. One salary, one is cash payment. Tell me, sir, what is the entry? Salary is an expenses. When expense goes up, it will be debit. Two, cash is an asset. When we pay from cash, the cash balance will decrease. Correct or no? So when asset decreases, it will be credit. 5,000 and 5,000. Correct? Now, understand how ledger is posted. At the same time, understand how whatever I told you, debit balance, credit balance, you will understand. Let's open the ledger of salary and cash. Salary, cash. Clear? Yes? Okay. Now, debit, credit. Correct? Yes? Now understand. Salary is debited. So we will start on the salary account debit side. Salary is getting debited, correct or no? So in salary account, we'll start on the debit side. Two, simple. Clear? Illi cash, we'll say we had 5,000 rupees cash balance. Okay. So let's take. Oh, sorry. Correct only, no? Buy balance borrowed, two balance brought down. Two balance brought down. Asset account. This two balance brought down is nothing but our opening balance. That means we had cash of 5,000 rupees. Clear? We had cash of 5,000 rupees. Now don't worry about if you don't understand how it is written, but first you understand, then you will automatically understand this also. Two balance brought down is 5,000 rupees. That means we had a cash balance of 5,000 rupees. Now, cash is credited or debited? Credited. So we should start on the credit side. So it will be by clear? Yes. Let's take this as 10,000. Huh? Now first let's come to expense. Leave cash, you forget about it. Expense. Expense should have which balance? Now close this. Which balance you are getting? 5,000 here, 0 here. Which balance are you getting? Debit balance, correct or no? Debit balance means what? Debit side total will be higher than credit side. That is the meaning of debit balance. Clear? In this case, debit side is higher than the credit side. Now what happens? Here also 5,000 barbeku. So what will happen to here, sir? There is nothing to make this 5,000. Correct or no? So this is nothing but by transfer to P&L. This is called as balancing figure. So why it is called as balancing figure? What is the rule? Debit, credit should be balanced. What is balancing? This is playing the role of balancing. Correct or no? So that is why it is called as balancing figure. Clear? Is everybody understanding? Yeah. Now let's come to cash. Now, cash is an asset, apa? Which balance it should have? Shall we test it? Which balance it is having? Which side total is higher? Debit side total is only higher. Correct or no? But how much we actually need total? 10,000. But how much we are getting on the credit side? 5,000. So we have to get here also 10,000. So what to do? Balance should be put in place. So that balance is nothing but called as balancing figure. Correct? Balancing figure. Yes. Now this we call it as by balance carry forwarded. I told you only income and expense will be transferred to P&L. Assets and liabilities will be carry forwarded. Now I will explain this cash account in layman language. Understand carefully. If you understand this concept is clear. You started with how much cash? 10,000. 5,000 you spent. What is remaining? That is this. By balance carried down. Understanding? So you are left with 5,000. Next year you will start with the 5,000. Correct or no, everybody? So next year when you open this account, this balance carry forward will come on the opposite side. To balance brought down or carried down, whatever it is. Sir, why we are bringing it on the opposite side is the next question. Correct or no? Why we are bringing it? Cash is what account, appa? Asset account. Say if you would have bought this on this side, okay, let's say there is no this one, we straight away bought it here only. By balance bought down. ಹೀಗೆ ಬರುತ್ತೆ ಅಂತ ಇಟ್ಕೊಳ್ಳಿ. Total. Which balance you are getting? Which balance you should always get? Understanding? So always to balance brought down. So there, what is the meaning you understood? Asset account will always have a debit balance, and when you start next year, it will always start from the debit side only. The opening balance will roll forward on the debit side itself.
Sir, what if you have a credit balance?
Impossible, sir. Then it will never be an asset account. That is the rule I am telling. No, asset account should always have a debit balance. When is the possibility that you will have credit balance? Say in terms of example, cash only, let's say. Can anytime you have credit balance cash higher than debit balance? That means without cash you are making payment. Understanding my logic? Say for example, you have only 5,000 here. You record a salary 10,000. How is it possible? How did you pay 10,000 when you are having only 5,000 in your account? Understanding? Logic is there. Nothing in accounts is illogical. Clear? Everything is layman language, sir, provided you understand. Now how you understood cash account? Simple term. 10,000 you started with, 5,000 you paid. What is remaining? 5,000. That is balance carry forwarded. Clear, everybody? But income and expense are not like that. That income and expenditure is for that particular year. You close that year. Am I clear? Yes. So today we discussed what all in the second chapter? Fatafat. Just tell me. What is journal entry? How do we record the journal entry? Correct? How? First we categorize into 5 items. Asset, liability, income, expenses, capital. Asset and expenses in one group. Increase debit, decrease credit. Income, liability, capital. Increase credit, decrease debit. Correct? Traditional system of this is called as modern. Traditional three classification: personal, real, nominal. Personally, three: natural, artificial, representative. Example of natural, me and you. Example of artificial, company. Example of representative, payable, salary payable, rent payable, all those things. Correct? What is the rule of personal account? Debit the receiver, credit the give. Rule of real account: debit what comes in, credit what goes out. What is real accounts for? Assets. Next, nominal. What is nominal account for? Income and expenses, gain and losses. Debit all your expenses and losses, credit all your income and. Am I clear? Yes? Okay. Next, quickly revising. What are the first book of accounting? Primary book, journal. From there, you do a process called as posting, where you classify and put it under ledger. So, journal is recorded in chronological order, ledgers in analytical order. Correct? So, individual account. But if you go to individual ledger accounts, it is again recorded in chronological order only. Right? Yes. Next, after that, you will summarize and prepare trial balance. From there, you will prepare balance sheet and P&L, from where you will interpret the things. Now, how does ledger looks? T-shape. Debit, credit. Particulars, amount. Asset and expense will always have a debit balance. What do you mean by debit balance? The debit side total will be higher than the credit side total. So, balancing figure will always come on the credit side. Whereas, income and liability will always have a credit balance. That means what? Credit side total will be higher than the debit side. So, the balancing figure will come on the debit side. Clear? Yes? Okay. That is it for today. We'll end the session. Thank you.